Straight to business. Charles Pellegrin is here. He's starting with a market update 30 days now into the Iran war, Charles.
The conflict between Iran and the U.S. and Israel now entering its fifth week, and the ripples on the global economy continue to be felt, especially as more events appear to be signaling towards further escalation. Let's start by looking at oil prices. They're rising considerably this Monday, whether it's the European North Sea Brent crude benchmark, which is above the $115 a barrel mark, or the U.S. West Texas Intermediate benchmark, both higher. The Brent actually on track to see its biggest monthly gain on record before the U.S. and Israel launched its missile strikes against Iran on February 28th. A barrel of Brent traded over $70 a barrel. It was even just over the $60 a barrel mark at the end of last year. The last spike of the sort we saw was in the wake of Russia's full-scale invasion of Ukraine in early 2022, which led to, obviously, Russian oil being sanctioned.
Yeah, you mentioned, Charles, concern over escalation being a driving force for these energy prices climbing.
A couple of things over the weekend are playing a part here, and a map of the Middle East will help us make sense of it. First off, Iran-backed Houthi rebels in Yemen struck Israel over the weekend, opening a new front in the war as they had until then stayed on the sidelines. And this is raising concerns that they could disrupt shipping on the Babalmandeb Strait, which connects the Gulf of Aden with the Red Sea and the Suez Canal, something they've already done in the past. Some estimates show that 10% of the world's oil supply transits through that point. So if you add this to the disruption already ongoing in the Iranian-controlled Strait of Hormuz, which affects about 20% of global oil supply, then you have even more supply pressure on oil markets. In addition to that, you have the U.S. President Donald Trump, his comments to the Financial Times saying that the U.S., quote, can take the oil in Iran, possibly by seizing the country's major fuel export hub on Karg Island, and drawing parallels with what he's done in Venezuela, i.e. effectively taking control of that country's oil industry. And there's also the possibility of seeing U.S. troops on the ground, boots on the ground in Iran, something Tehran's parliament speaker has said they are already waiting for. All of this is what's pointing to further escalation and further volatility in the markets.
Yeah, volatility over the last few hours?
Well, let's have a look at those stock markets. Oil goes up generally, stocks go down. More money spent on energy means less money spent on investments for companies. It means consumers have less of a budget to spend on other goods, raising the specter of an economic slowdown. In Asia, we're seeing markets mostly in the red, with the Kospi and Seoul leading the losses. The Nikkei in Tokyo at one point falling over 3% as well, with the Bank of Japan considering raising rates again in March as rising energy prices are adding to inflation pressures. Let's look at the picture in Europe as well. Markets opening the week lower as well on the similar concerns. The Paris CAC down 0.25% lower. The DAX in Frankfurt down 0.4% lower.
Now, the widening of the war is certain, of course, to bring yet more disruption for international maritime shipping, not just for the Gulf energy exports stuck behind the Strait of Hormuz.
The Middle East is also a key transit hub for the global used car market, particularly for vehicles coming from Asian automaking giants Japan and South Korea. Cargo ships that normally would be sent through Hormuz are now being rerouted, backing up ports across Southeast Asia and Southern Asia as well, creating massive headaches for the mostly small businesses that make the international market run. Brian Quinn has the story.
At this dealership in the Sri Lankan capital of Colombo, customers come seeking used cars from Japan, where strict maintenance regulations mean steadfast reliability on the second-hand market. But supply here is quickly becoming a problem. 500 cars due to arrive in Sri Lanka are now stuck at sea, their cargo ship unable to dock as its port of call is full with ships diverted from Dubai's Jebel Ali.
Due to the congestion of ships that was en route to Jebel Ali, they were docked in the out harbour in Hambantota port. The Japanese shipping lines were unsure if they could bring in new vessels to Sri Lanka because of the port congestion.
The situation is indicative of wider disruption as ripple effects of the U.S. and Israel's war on Iran spread through global supply chains. Some $19 billion worth of used cars were exported from Japan and South Korea last year. Of the nearly 900,000 coming from South Korea, more than a third went to the Middle East. In Incheon, stock is piling up in lots during what is usually the busiest time of year.
The Middle East is our most critical and strategic market. From there, we branch out into Turkey and even Eastern Europe. But now the whole network is more or less paralyzed.
The global used car market is run mostly by small businesses. With transport costs rising and even shipping containers growing scarce, many are now facing the prospect of having to return stock already at sea back to its country of origin.
Charles Pellegrin with business on France 24.